You have one precious life. How will you make your money work for you? It's time for Sage Money Conversations, where your financial happiness and confidence are always the subject. Here's your host, certified financial planner, Barbara Norman.
Hello and welcome to Sage Money Conversations. I'm your host, Barbara Norman. Taxes are stressful, and a lot of the times we don't understand them. The rules are changing all of the time. So today we are blessed to have Ann Burns with us. She is a CPA. She's had 15 years practicing taxes. What I love about Ann is she was sharing with me about her bulletin board and the thank you cards that she looks up at as people kind of come in and get delivery of their tax returns, and she takes the stress right out of it. So today what we're going to do is we're going to start breaking down taxes and how they work. So Ann, welcome to the show.
Thank you, Barbara.
So let's just jump right in. Let's talk about tax brackets and how they work. And I know we get these things like married filing jointly, single, head of household. Explain to us how tax brackets work.
So the thing with tax brackets is I hear probably more than anything else that people are like, oh, I don't know, is this going to send me into another tax bracket? And a very common misconception is that going into another tax bracket means all of your income is taxed at some higher rate. And that's not how tax brackets work. So how they work is the first X amount of income you get is taxed at 0%, and then a little bit at 10%, and a little bit at the next percentage. And so it's kind of like steps. And every time you reach a new level of income, then that income only is taxed at that higher rate. And so I think I would never encourage somebody to not take income because it's going to put them in a higher tax bracket. You're still going to end up with more money even after you pay taxes on that. And it doesn't change how the rest of your income is taxed.
See, and I think that's an important distinction. I know when I get my tax return, you've got that cover sheet that shows, it compares the years, and at the bottom it shows your tax rate and it shows your effective tax rate. Tell us what that effective tax rate means.
That effective tax rate takes into account all of your deductions, whether you itemize deductions or you don't. Basically, it's your income divided, or your tax actually divided by your income becomes your effective tax rate. And that is after all of your deductions and any applicable credits.
See, and I think that goes to the issue too, what you're talking about, how that tiered tax system works is like my income might look like I'm in a 20% bracket, but maybe my effective rate is only 12 or 13%, right?
That is correct. But then when you think about that, any more income you get would be taxed at that 20% because you've already used up all your deductions.
Right. So let's talk a little bit about the deductions. So some people get to itemize, some people have to use the standard deduction. So tell us what the difference is there.
The difference, and this is wildly different for federal and states right now. For standard deduction, you just take whatever the federal government has as the standard deduction, which is currently approximately $12,000 if you're single or $24,000 if you're married. And then if you itemize, you get to deduct certain expenses such as real estate taxes, mortgage interest, charities are kind of the most common of those. Right. If you are unfortunate to have high medical expenses, that might be one.
So that's itemizing. So let's say we've got these new SALT deductions, which we're going to talk about in a minute. But so let's just say that I can't itemize. Then I get the standard deduction.
Then you get the standard deduction, which is currently pretty high based on, compared to historical things of, 12 or 13,000 or 24 or 25,000 if you're married.
So, and you get the higher of the two. So nobody's really discriminated against, which I like.
Correct. You get whichever one is higher, your itemized or your standard.
Now, a lot of us had to go from itemizing deductions to just the standard deduction, and that's because of that new SALT limitation. So tell us what the SALT limitation is.
That's a state and local tax limitation, and it is currently limited to $10,000 per tax return, which is a little bit of a marriage penalty because if you're single, you get a $10,000 deduction. And you only need 2,000 or 3,000 of other deductions to start itemizing and get the benefit of those. But if you're married, you get a $10,000 deduction for taxes maximum, and you have to get above 24 or 25,000 before you get the benefit of your other deductions.
Wow, that is a marriage penalty.
Yeah.
Um, State and local. So what are they saying there? So we talk about property taxes. We used to be able to deduct what we paid in state income taxes, and we can't do that anymore, right?
Well, that's part of it. So it's a combination of your total property taxes, state income taxes, the little tiny part of your DMV fee that's actually taxes, all of that. However much that adds up to, you can only deduct up to $10,000.
See, and that's pretty awful to me because we live in a state with high property values. And so my property taxes could easily be $8,000, $12,000. I have to pay tax, right? State income taxes. We can't deduct that after $10,000. So it's almost a tax on top of a tax, right?
Well, it can certainly feel that way. It's just, it's a limitation on deductions, and it's not popular in the states that have high income tax rates and high property taxes. And that's exactly why, because it feels like a penalty to some people.
Yeah. So let's switch over real quick to state income taxes. Are there any deductions there that we get to use? You said they're wildly different. So talk to us about how state taxes work.
So the state taxes have different itemized deduction limitations. So currently for California, there is no SALT limitation, although you don't get to deduct state income taxes. Right. But I certainly have clients who are paying more than $10,000 a year in property taxes. And so they're likely to itemize for California, whether or not they do for federal taxes.
So essentially, you could do a standard deduction on federal and still itemize on state. Is that right?
Yes, and I have quite a few clients who do that.
Well, that's great. I just learned something.
Good.
Yay. Are there any good tax deductions out there still?
I mean, the thing I think people have the most control over is charitable donations, but it's only a good deduction if you're charitably inclined, because otherwise it's a very expensive way to save on taxes. And there are some strategies to cope with the new tax law, this $24,000 or $25,000 or $12,000 standard deduction. You can bunch up and do a lot more charity in one year, and a vehicle that lets you do that but still donate over time is a donor advised fund.
Mm-hmm. Tell us what a donor advised fund is.
In a donor advised fund, you kind of front load your charitable donations. You put some dollar amount, $10, $20, $30, $50,000 into this fund, and you get a deduction at the time you put the money into the fund. And then that money is just sitting in that donor advised fund, and you can, out of that fund, make donations to whatever charities you want to. You don't get a second deduction because you've already taken it. But if you fund that with a large enough amount to get a good tax deduction one year, and then the next year you take the standard deduction, that's a choice some people are making to kind of maximize their deduction benefits.
That's kind of cool. So if I have a year where my income is really high, if I want to do a donor advised fund and pre-fund my next 5 years of charitable contributions, that's a great strategy.
Absolutely. And I do have people who have done that recently.
I know that one of the most overlooked deductions, or one of the most overlooked tax plays that I see, are people who are taking required minimum distributions, and then out of a separate checking account, they're writing checks to a charity. Talk to us about a QCD, a qualified charitable distribution, and why that's better than just writing a check out of my checkbook.
The qualified charitable distribution is a fantastic option for people who are allowed to do it, which is most people who are required to take IRA distributions are allowed to do that up to $100,000. And that is great because if you send the money directly to a charity out of your IRA, you don't have to claim it as income. And a lower income is always better than more deductions for a multitude of reasons. The first of which is you don't have to worry about whether you itemize deductions or not. But it also could impact how much of your Social Security is taxable, or potentially even future Medicare costs, depending on what your adjusted gross income is.
And that's huge. That's just huge. So, and I know in your firm too, you guys are really proactive about Roth conversions. Is that a good idea still?
It always depends on the person, but as a general statement, I would say yes. If you fit all the other things, having money in a Roth IRA is one of the best places you can have it. because it's not taxable when you pull it out, assuming you've met all the requirements.
See, and I think Roths are great. If I go into my retirement and 100% of my assets are in an IRA, it's 100% taxable coming out. And like we talked about earlier, that could throw you into a higher tax bracket. It could mess with your Medicare premiums. But if we've got some of that Roth and some of that IRA, well, that really helps out tax-wise. So
yeah, it's good to have a source of where you can get money and not increase your tax bill just by taking out some extra money.
Right. And how cool is that? So when you go to look at a Roth conversion, what are some of the things, Anne, that you're looking for?
Looking for, is this year a abnormally low income year for some reason? For example, in 2020, a lot of people had much lower income. So that was a good year to look at doing Roth conversions. If something happened where you had an unusual loss, you would want to take advantage of low tax rates and try to get some money into a future tax exempt account. And some people do it just knowing, for example, that you're always going to be in a set tax bracket. But if you could, there's a strategy of kind of filling a tax bracket. Like, oh, I could take another 20,000 of income and it would be in this 22% tax bracket. And because I have a pension, I'm always going to have 22% tax, and tax rates might go up. So some people choose to pay their current tax rate on a Roth conversion, assuming that in the future tax rates will be higher and they'll have this money that won't be taxed when they take it.
And I think that proactive thinking, that proactive, looking ahead, that is so important, because what it can save you in taxes and Medicare premiums down the road is huge. And I love that you guys are proactive in that way, because not many CPA firms are. You go in, they slap the numbers on the tax return, you're done. But I love the tax planning you do. Look, are there any good tax credits? And explain what the difference is between a tax deduction and a tax credit. And then tell us, Anne, are there any good tax credits out there still?
The difference is a deduction lowers your taxable income. So the benefit of the deduction is basically your tax percentage, whereas a credit is actually lowering your tax. So it's a much higher benefit to get a credit than a tax. As to whether or not there are any good ones, it really there's nothing that like just anyone can get. I feel like everything costs money. If you buy solar for a couple of years, unless it gets changed, there's still a solar tax credit, which is good. I think it's either 22 or 26% of the cost of your solar.
Wow.
Some of the electric cars still have a credit available, but you're spending money to save tax. Ideally, you're spending money for some other reason, and then you also get some tax benefit out of it.
Yeah, so don't let the tax tail wag the dog. Let's make sure it makes sense, correct?
Right. But then at the same time, if you were thinking, hey, maybe I want to buy an electric car, there's an IRS website and you can check to see, does this car qualify for any credits? That's a great, bonus of something you were going to do anyway, and maybe you could get a tax credit.
Okay, that's very cool. Do you remember what the website is?
No, I always just Google like IRS electric vehicle list, and it's somewhere on the irs.gov.
Okay, that's a great tip. Let's talk about backdoor Roths a little bit, because I know recently those have gotten a little bit more tough. It's even under question, are we still going to have backdoor Roths? For today, we do. Tell us what a backdoor Roth is and why someone would or would not do one of those.
A backdoor Roth is essentially you contribute to an IRA as a non-deductible. So maybe you make too much, you already have other retirement options, so you're not allowed to deduct an IRA contribution. Mm-hmm. So you contribute into your IRA and you don't deduct it, which gives you basis. And then you roll that over into a Roth IRA. And the big trick there is if you have any other IRA accounts, it's proportionately taxable, the amount of your taxable IRA and your basis. But if you don't have any other IRAs, say all your money is in a 401k type retirement account, then if you have no other IRAs and all you have is this amount that you contributed and couldn't deduct, you can roll that into a Roth IRA and not pay any tax because you didn't deduct the original contribution.
And I think that's a great strategy. But yeah, like you said, it's kind of a unique one in that if you have IRAs, probably won't work.
Right. You'll still end up paying some tax. So then you go back to maybe you just do conversions and pay the tax on that instead of going through a semi-complicated thing where you're still going to end up paying tax.
Right. This has been really informative. Can you think of any other ways that we can save taxes that we haven't really touched on?
The only other thing I could think of was kind of going back to our charitable discussion.
Okay.
Something that can work really well for people potentially is if they have highly appreciated stock, that can be donated to a qualified charity, and you get the donation at the fair market value of the stock, even if you have really low basis in it. So you don't have to like sell the stock and recognize a capital gain and donate cash. You can donate the stock. You get the full benefit of the deduction, and the charity gets stock that they can sell and don't pay tax because they're a charitable organization.
And I think that's huge. So let's play with the numbers a little bit, just so it makes it easy for our listeners. If I buy a stock for $10,000 and now it's worth $100,000, right? It's better for me to just give that stock at $100,000 to the charity. If I cash it out, pay taxes on $90,000, right? And then the money, go ahead. I'll let you play with that one a little.
Oh, I was just going to say, and that's a great example, because in that scenario, the charity would have a lot less cash to receive because you have to pay tax before you can give them the money out of it. Where if you just give them the stock and they sell it, they get 100% benefit. And so do you, because you don't have to claim the income and you get to take the deduction for the fair market value of the stock you donated.
And that's huge. That's just huge. This conversation's making me think of another question, another area I'd like to touch on, and that's capital gains taxes, because they're taxed differently than ordinary income. So would you touch on capital gains for us and how different that is, federal, and then we can talk about state?
Sure. So capital gains, one thing, there's a misconception. It is part of your income tax. It's not something you pay separately from your income tax return, but it's a subset of income. And if it's long-term, where you've owned it for more than a year, the capital gains are taxed at lower tax rates. The most common rate is 15%, but it does change some depending on your overall tax bracket.
Right. So it could be 0, it could be as much as 20. So 0, 15, and 20.
Correct. Which is a federal thing. California does not have any special tax rates for different types of income.
Which is kind of a bummer, but we still at least get the federal tax break.
Right.
So good. Any other areas that you want to touch on if I was trying to understand taxes, how they work? Have we missed anything?
I think those are really the big things. Yeah, the biggest thing I want people to really understand is the tax brackets, just because I hear so often, I don't want to go into another tax bracket. But you'll make more money overall.
Right. And I think that's an important distinction. When people think about going into a higher tax bracket, you're right. They think all of their income is going to get taxed at that rate. And it's really not.
Right. I also think it's important for people to work with somebody who can explain their taxes to them in a way that they understand, because it's pretty frightening how many people have no idea what's on their tax return, and they just sign and file, and you ask them a question and they're like, I don't know.
You bring up an important point. I think it's essential that people understand their tax returns, because how do we go through the year and be proactive on how we pay taxes or how we take our deductions?
Yeah.
And we talked too, I think towards the end of the year is always good to do a check-in, like in October, hey, let's do a tax planning meeting, see if there's anything we can still capture for the year. I think if we wait till April 15th, it's probably a little bit too late to do the planning for the prior year.
Absolutely. If you want to do any planning, you have to do it before year end. And you definitely would want to start before December, because it takes time for people to look at things, and you may want to take some action that you can't do overnight.
Exactly. Anne, you have been absolutely fantastic. Thank you for demystifying taxes. If our listeners want to find you, where would they find Anne?
They can find me on our firm website, strumlauburncpas.com, or I'm on LinkedIn as well.
Very good. And we'll put a link to your firm in this podcast so they can find you. And thank you so much for the wealth of information and kind of breaking it down for us today.
You're quite welcome. Thanks for having me.
Advisory services are offered through Barbara J. Norman, LLC, an investment advisor in the states of California and Texas. The information contained herein should in no way be construed or interpreted as a solicitation to sell, nor an offer to sell advisory services to any residents of any state other than the state of California, or where otherwise legally permitted. All content is for information purposes only. It is not intended to provide any tax or legal advice or provide the basis for any financial decisions. The information contained in this material has been derived from sources believed to be reliable, but is not guaranteed as to accuracy and completeness and does not purport to be complete analysis of the materials discussed. The opinions expressed do not necessarily reflect those of SagePath Solutions and are subject to change without notice.